Good day all. Ira Epstein of Linn Associates with your financial market wrap-up for this Monday, the 6th of January, 2020. Just getting on now to 4:45 p.m. We got a few minutes before we're there, Central Time. What a comeback in the stock market. You know, today I came into the market, as everybody over the weekend did, wondering, are we going to get a reprisal from Iran? What's it going to be? What's going to happen? Well, what did happen is yesterday, if you get my newsletter, I had written that the Iraqi parliament voted to have the U.S. coalition forces leave Iraq. Now, the president came out and he said, oh, we'll leave all right, but you're going to have to pay us billions for doing whatever we did. Well, that's the anger. The reality is our senior Marine Corps general came out, and from what Reuters is reporting, we have turned in a letter to the Iraqi government that within days to weeks, we will be pulling out coalition forces. How many, I don't know, will be left there, but it sounds as though we're going to meet that. And that's taming things down. As things tamed down, you came back. It didn't hurt the stock market that Boeing is making settlements with American Airlines, I think one of the Mexican airlines. So we're starting to see the market a little more stable. But there's warning signs here. This type of volatility is dangerous. What else happened? Money on the sideline stepped in today. It was a question at the beginning of the year, where was it going to start placing itself? Well, apparently it thought that this situation created enough depth of a break for some money to be deployed. You even stayed up in the metals, the dollar down a little, but if you take a look, the yen broke fairly hard and bonds and notes down, so the market, if you will, took off some of that, that it didn't want to have risk at play and put some risk play back on. Now, as we take a look at the weekly chart of the S&P, can't get away from it with this week's beginning. It's a new all-time high close. Can't get away from that. What else can't you get away from? You're getting distribution. The range of Friday is what you're caught between right now. And as you can see on Friday, you stepped into that range today, and as we step into the swing line, you've now got a higher high, lower low pattern. So what I have now is price distribution going on. How it resolves itself, I can't tell you, but we can use some of the indicators to get some ideas. First off, where did the market fall back to? If we go back, this was last Thursday. The support's the 18-day average of closes. The market made a new high, falls hard, gets down to 3206.75, challenging the 18-day average at 3204.50. Didn't quite hit it. Today, for good measure, the low's 3208.75. The 18-day average 3210.5. It hits what I call that line in the sand, and the market stopped literally against that and finished the day sharply higher off of it. All it did is hold that number. That's good news, but you're not trending. You have a higher high and a lower low. Where's the Bollinger top? If the market takes out Friday's high, I would look for that number, the 3277 level, to offer some resistance in the marketplace. What about momentum? Well, that bothers me. You lost the embedded reading today. Now, when can you gain back that momentum? Let me show you what it looks like. This is when the two numbers that make up the slow stochastic, they're called a K and a D line, and it's the blue and the red, and they're both going sideways over 80. Often, the market gives a warning by one of the lines, and it'll be the K line first, stepping out of that 80 pattern, and that's what you did. The only time it can regain it is the very next day of trade. So you'll often see if it pops that night or if it makes a move late in the day, you're watching that. So now I'm watching this very closely. What else? Well, the fact that it's already hit the 18-day average tells me that momentum may be turning down, putting into play the 31.43 or whatever that number ends up tomorrow, but more likely spinning action can happen in this market. And by that I mean just moving back and forth here. NASDAQ did not hit the 18-day average, did not lose its embedded reading, and it's got a pattern, though, of a lower low and a higher high. It, too, is very much in a distribution area. The bias is up, but this runs the market. The embedded reading, when you have a slow stochastic that is locked in until it is lost, you're looking for the pros to step in on the brakes and keep trying to drive the market up to current resistance levels, in this case the high that we made on Friday. In the Dow, like the S&P, you've lost the embedded reading. Now, this was the action on Thursday. Here's Friday's action. You lost the embedded reading on Friday. The only day you could get it back would have been today. And instead, the markets got it lost. But it also went to that 18-day average. Let's go back to Friday. You hadn't hit this 18-day average. You did it today. It puts confusion at work. And the reason is the market saying, no, the breaks are all going to get bought and the market's going to continue up, or is the market converted itself to an overbought condition? That's where I think we're at. I think that we're in an overbought condition. And overbought's always dangerous because it's where the greed steps in. People say, I've missed the move, there was the break, it's going to keep going. Not telling you that's what's going to happen. I'm reading the chart action. There's a very big difference. In the Russell, we've been in a mini downtrend. You've had the lower highs, lower lows. Even today's action with the settlement at 1663 is right back to the 18-day average. Didn't really go anywhere. Momentum has been breaking down, and with that momentum breakdown, and that's what we're talking is happening in the Dow, in the S&P, the market is stalled, and that's what I'm wondering is going to happen there. We'll see. I don't have reasons to be super bearish because you're already down to the 18-day average in those markets, and you're pretty neutral right here. But if I had to give the bias in this market, it's still to the downside. In the VIX, Friday, I thought the pros had sold the upper Bollinger Band, trying to get back out, down either first possibly to the 100-day average, then the 18. This morning, you had that rally, and I was telling my subscribers in the morning, hey, folks, you're back to that resistance. I wouldn't be surprised if the pros are stepping back in again. I didn't expect today to close higher in stocks, in all honesty, but that's what's happened. Now, I'm still looking for them to cover against that 18-day average. This is a market that's had an uptrend, and it's hit key resistance at the upper Bollinger Band, the black dashed line, and the 100-day average. The importance of the Bollinger Band is often on the first challenge of it, the market backs away. Does it have to every time? Absolutely not. Does it more times than not? You go do your own work on the chart. I think you'll come to the conclusions that I have. In the bond market, we've gone from attacking the lower Bollinger Band on Friday to coming up to the higher one today. I don't know how to trade that. Also, I don't see a trend. I've got now a higher high, a lower low, and a whipsaw in this market. Really difficult to try to catch it. What about the 10-year note? Well, all I can say is that on rallies, I think pros take some money off the table on the first challenge of a Bollinger Band, be it to the upside or to the downside. So that's what I think's going on. But unlike the bond market, this is a trend. Higher lows, higher highs. It never did hit the lower Bollinger Band. If we come to TLT, it's more similar to the bond market. It made the lower low, then it swung around last Friday, made the higher high, carried through today to the upper Bollinger Band. If we'll take a look, if I can, let's see if I can get back here. I should be able to. There it goes. On Friday, you had not gone for that upper Bollinger Band. If the market's going to continue, I'd be looking for resistance in between that number and the 100-day average. And as you can see, that's pretty much what happened in the market. In the dollar index, I still see the trend is down. Oversold, but down. Lower highs, lower lows, resistance, the 18-day average of closes. What would negate that thinking on my part is a market getting over 96, 79.5, and then closing over wherever the 18-day average is at that moment. What about potential support to the downside? The lower Bollinger Band is an oversold market. Eurocurrency, today it confirmed an uptrend. Higher lows on the swing line, as I've marked for you. You've had the higher highs. Again, pulling back, and here you made it. If you come down, I'm looking for support on a bullish crossover yet of the 18-day average and the 100 in that number if it's challenged. Market comes down, and you're getting your bounce. Now, what would prove me wrong? What would make me have to say, hey, I've got to change my opinion? Take out this 111.73.5. Not before that. If you don't take out that high, you'd have lower highs, lower lows underneath both numbers. So that would be my fear in the market. In the British pound, I see no trend. I see the market with lower highs, look at this low and that one, higher lows stuck against the 18-day average of closes. What about the Japanese yen? What's broken words that I'll give you? The first challenge of an upper Bollinger Band, the way that I teach in my charting course, I think the pros are waiting and they take some money off the table. The market gets there and it inevitably looks the most bullish when it gets to that number. And then today, the market backed down. Now we're overbought in a market that is not trending. You have a lower low and a higher high and a widening of the Bollinger Bands, resistance between this high up to the 100-day average. Do I think this market can come back to life? If Iran does a reprisal, it would not surprise me to see that market come to life. What's the bias in the market? As long as it's over the 18-day average, it still has upside bias. Bitcoin, what's the number it hit today and ran into the resistance? Come on. Upper Bollinger Band, got right to it, market just stalled. What's the trend? There is none. You're trading sideways in these Bollinger Bands, the black dashed lines, 95% of the time you do that. The 18-day average is the neutral number. You've got a lower low and a higher high number. What about Brent versus WTI? I'm not going to tell you I'm not surprised that you're getting a rally of Brent that is stronger to WTI. Which oil in the world could come under attack by the Iranians? I don't think it's our WTI. It could be the Brent, which is where the pros are playing that. Instead of playing the outrights, I think they're playing that. Now, while the energy markets closed higher today, the last trades of the day were about 20 cents lower, actually about 50 cents lower than this. So I still think this resistance at the upper Bollinger Band, you have to pay attention to. Momentum is turning down on you before prices. You could easily see prices back to that 18-day average. I'd be paying attention to that momentum. But as you know, being short when you're waiting for the next shoe to drop, it's pretty difficult. There are other places to put money at risk, is the way I'm going to say it. Higher lows, higher highs, upper Bollinger Band. I think the pros are coming out of longs, not adding to them. What about gasoline? Upper Bollinger Band. I'm going to keep repeating it. That's where I think the pros take money off the table. I wouldn't be surprised to get more of a retracement out of this. And in nat gas, you have an oversold condition that is paying attention to the lower Bollinger Band, refuses to stay under it. The first cold spell probably gets a nice bounce out of this market, but I'm not a weatherman playing for it. What I do think is the pros, they're coming out against the Bollinger Band if they're selling, and because of the oversold condition, I have my doubts that they're taking large positions in it. Maybe you get a rally to the 18-day average of closes. Right now in the stock market, I saw money deployed today. And over the weekend, I think we were all grimacing what today was going to offer in the markets. We didn't know if Iran was going to do a reprisal, what was the magnitude going to be, or whatever. This is the time that if you were looking to tiptoe in the market, instead of full-size contracts, some might have used micro stock indices. They're 1/10 the size of the regular contract, and margins are 1/10. Our commissions are dirt cheap on them. They're like $1 a side to trade these. And people have said to me, what can you make on them? I write my own updates. For those of you that watch it, the question is not what you can make, maybe what you can lose in them. You're trading 1/10 the size. But people use these to build positions. And yes, you can build 10 of them on a side and sell a full-size contract against it. It's called fungible. They'll offset each other at the end. So there's ways to work with this. To find out more, call my staff. They'll be happy to explain how this all works. And again, this is a great way for you newer traders, stock indices traders, to want to play and get a feel for the market. You can also read about it. Go to our website, but when you go to www.iraepstein.com, do a / in your bar, in your information bar, and type in micro after it. It'll take you right to the page that we want you to be at. I'm Ira Epstein. You have a great day, and I'll talk to you tomorrow.